It's obviously a very dynamic environment, and that's why we've continued to withdraw our guidance. But what we have seen across the portfolio is that as the restrictions ease and people feel safe, they engage in activity. And as a result, if you look at our retail town centres, they're open. 98% of stores are open across the country. If you exclude Victoria, 94% with Victoria in there. We've continued to transact in residential and retirement living, and we're seeing good demand in logistics space in particular. So ultimately, it's all going to come down to the rate of new cases. Right now, across the nation outside of Victoria, we're seeing a good level of very low transmission. And so in that regard, if it stays that way, then we should continue to trend higher from here in terms of business activity.
Now, you mentioned the uncertainty and you did mention the retail divisions as well. In terms of perhaps, I suppose, like the rental situation when it does come to a lot of these retailers, I saw that you had 83% for H2, 70% only for Q4, and you're basically, the hit that you're taking in terms of the write-downs is centred around the property valuations when it comes to retail. Are you seeing any signs of positivity, just say in the last couple of months or so, that perhaps buoy you as to what we could potentially see on that end moving forward?
Yeah, I think there's a whole range of statistics. After a pretty significant negative in the height of the lockdowns, we saw a quick improvement in foot traffic and stores open. And as I mentioned now, 98% ex-Victoria. Foot traffic is only off around 5% from pre-COVID levels. We've reached agreement with 52% of our retailers who've been heavily impacted by the pandemic. Rental collections in commercial property sitting at 70%. And so we've made a lot of progress. Stores are open and operating safely. And importantly, for a lot of retailers, we've either extended leases or done new deals and extended leases. So these are all things that point to the diversified nature of our portfolio, non-metropolitan and metropolitan, and also the fact that we've got a heavy skew to non-discretionary food and services in particular at more than 70% of income.
Speaking of the diversification of your portfolio, you're even further rebalancing towards perhaps workplace and logistics like you did mention earlier. Do you think that logistics, considering what we've seen in COVID, considering the shift to the work from home and online shopping environment, that logistics could be the big growth driver moving forward?
Well, we certainly believe that sector will continue to benefit from both growth in online and also onshoring of supply chain. We've seen vulnerabilities in global supply chain. So there's good demand, both in logistics and also we're seeing in business parks, which are a beneficiary, I guess, of satellite working and also concentration of activity in growth parts of the economy. So we announced the acquisition of the J&J headquarters in Macquarie Park and a deal to develop a new headquarters for J&J, and also we announced the pre-commitment to a whole building of a large international tenant. And that reflects the fact that Macquarie Park is all about technology, health and government, which are obviously growing, and then logistics is benefiting from those trends that I mentioned. So with a $3.1 billion pipeline in logistics, we're really well positioned to grow with those trends.